Okay, back for our last section for Chapter 8. This is going to be looking at a bank reconciliation, how to prepare one for your company. When we're thinking about a bank reconciliation, we have to think about what is going to be adjusted on the bank side and what is going to be adjusted on the book side. So the point of it is to make sure that we can reconcile the differences, because we have to remember not every check will have cleared. Not every deposit will have been made by the point when they print the bank statement. So we're getting our bank statement and we want to reconcile it to our cash account. So our book balance is the cash account that we have in our bank. The bank balance comes from the bank statement that they're going to send us. And we're going to be trying to reconcile them to make sure that we've explained any differences between the checking account balance and the bank's balance that's reported on their statement. Here we see that we have some adjustments. On the bank side, on the left, there is something we would add any deposits in transit. Now, when I say deposits in transit, what that means is deposits that we've made to the bank, but they haven't processed as of the date of the statement. Now, this typically only happens around the last day of the statement. So, for example, if you made a deposit on Friday the 30th and your statement was printed on the 30th, you would, even though you deposited that day, they're not going to process it until that following Monday. So that would be a deposit in transit where it's not processed through their side, but we know about it. The next line down, you see where it says subtract outstanding checks. Outstanding checks are checks that we've written, so the company, knows about them, and the bank hasn't cashed them yet. So they haven't cleared our bank yet. So whoever we wrote them to, they haven't deposited them and it hasn't cleared yet. Now again, with electronic transfers, this process happens much faster than it used to, but there still is a lag time. It could be a couple of days. That person might hold on to the check for a week or two. So you have to account for those that are outstanding. And then we always have the possibility of a bank error. So we have to add or subtract those to correct those sides. Now on the other side, the book side, this is adjusting for our things. And we're adjusting for things that the bank statement is telling us about. So there's things that the bank may know about that we don't know about until we get that statement. So an example would be interest earned. If we have interest that we've earned on our balance from the bank, we don't know how much until they give us the bank statement that tells us what. So once we get that, we have to add that interest to our book balance because it increases the cash in our account. We also might have to add in any receipts that they've received. So they might have received cash electronically for us that we don't know about until they tell us. So we might see they received an electronic funds transfer that a customer paid them electronically. So we have to add that to our book balance then. Some deductions are going to be bank fees and insufficient funds checks. That's what the NSF stands for, insufficient funds. So if we had a fee because our bank charged us, then that's going to be deducted. And then if we have checks that didn't clear, we would have to deduct them. And then again, same thing, if we have errors on a book side, we have to correct them too. So here just a kind of an outline, and this is a good sheet to keep handy for you that has what we do on the bank side and the book side. So we have the cash balance that we're going to have for the bank statement. That's what we're going to start with. And we have our balance that we're going to have on the book side. At the end, that adjusted cash balance should equal. If they don't, we're still missing something. So we want to try to reconcile them so that they do equal at the end of this. We're going to follow 9 steps to prepare a bank reconciliation. This here has the first 4 steps listed. So we're going to identify the bank statement balance of the cash account, the balance per the bank. So this is from the bank statement. That's why it says bank statement balance at $2,050. This is for a company called Video Buster. So their bank statement was $2,050. That's what their bank statement said they had. And then we have to identify and list any unrecorded deposits or bank errors that understated the bank balance. And we're going to add those to the bank balance. So Video Busters had a $145 deposit that was placed in the bank's night depository on October 31st, but it hadn't been recorded on the bank statement yet. So we're going to add that to the balance. That gives us that $21.95. Then we're going to subtract out any outstanding checks or any bank errors that we may have had. In this case, we just have 2 checks. So Video Busters compare the canceled checks with their books, and they showed 2 checks that haven't cleared yet. Check 124 that was for $150, and check 126 that was for $200. So we're going to subtract those from the bank balance because we know we wrote them. The bank hasn't cleared them out yet, so they haven't deducted them yet. So we're going to deduct that, and that's going to give us an adjusted bank balance of $1845. So when we look at the other side, steps 5 through 8 are on the book side. So we take our book balance, which we get from our cash account, the balance per the book, and we have a balance of $1405. We're going to identify and list any unrecorded information from the bank, any interest earned, any errors understating the book balance, and we're going to add them to the book balance. So Video Busters bank statement included a credit memorandum showing the bank collected a note receivable for the company on October 23rd. The note's proceeds of $500 minus a $15 fee are credited to the company's account. So Video Busters bank statement also shows an $8 credit for interest earned on the average cash balance. So we see those 2 added. We didn't know about them before, so we're finding out when we receive the bank statement. So we're going to add those to our balance, and that's going to take us from $1405 to that $1898 on the right. Then we're going to deduct the things that reduced our bank balance. So we're going to identify and list any unrecorded information from the bank, so service charges, errors overstating the balance, and we're going to deduct them from that book balance. So the debits for Video Busters bank balance that are not recorded included a $23 charge for check printing and an insufficient fund check for $20 plus the $10 processing fee. So the check is dated October 16th and it was included on the book balance. So we had to take it back out because it didn't clear. And they're also charging us a fee. So we have those total deductions of $53, which brings our adjusted book balance down to $1845. So we can now see that we have a reconciliation because they do equal, and that's what we want to see. So one thing to note, even though we verify them, so we can see on this screen here that we have balanced the entries, but the things that we did on that book side, we haven't actually recorded yet. So only adjustments on the book side have to have a journal entry, but we have to go through each of those adjustments that we made and do a journal entry for them. So we can see that we had 4 adjustments to the book balance. We had 2 additions and 2 deductions. So let's look at how the entry would look for those. So our first one, we're receiving cash, right? Because we're adding it. So we're adding cash. We're going to debit cash, and we're going to credit the other side of that. For this, we were recording a note that was collected. So we recorded a reduction to notes receivable for $485. For the next one, again, interest was earned, so our cash increased, so we're debiting cash. We're crediting interest revenue for $8 to recognize the revenue that we earned from that interest. The 2 deductions, again, for the additions, we're debiting cash. Deductions, we're crediting cash because we're reducing cash on hand. So we had 2 costs. We had a miscellaneous expense for check printing, so we're going to debit miscellaneous expenses and credit cash for that $23. And then we have the NSF checks, where we're going to debit accounts receivable and credit cash for the $30. That's going to take us through to make sure that we know how to reconcile those entries that we did. So that's the example of the bank reconciliation. There are practice that will help that kind of be reinforced, and there's some additional handouts that should help also. The last part for Chapter 8 is computing the days sales uncollected ratio and using it to assess liquidity. So when we look at that, the ratio is calculated by taking the accounts receivable divided by net sales, and then getting that answer times 365 days. You can see here that they give Starbucks and Jack in the Box as examples. They give you the accounts receivable and the net sales. They do the calculations, and then you get the ratio for each of the 2. And then you can compare it, how they did this current year, 1 year ago, and 2 years ago. So that's our ratio for this chapter. That concludes Chapter 8. So please make sure that you have gone through and done the concept overview videos, you've done the SmartBook, you've watched these, and that'll help you prepare for the next part of the class. Thank you.